Welcome back to Growth Without Referrals. Today, I'm joined by Aaron Kroll, founder of Sterling Point Advisors. Aaron works in a very interesting segment of the market, helping lower middle market business owners navigate one of the most important moments in their careers, understanding what their business is worth and successfully guiding them through the process of selling it. What makes Aaron's model especially interesting is that Sterling Point operates as a boutique advisory firm. That means Aaron works directly with clients from the very first conversation through closing, staying closely involved throughout the entire transaction. Aaron, welcome to the show.
Thanks, Mark, for having me. Excited to be here.
Great. So, Aaron, let's start with how Sterling Point began. You mentioned that you started the firm in 2018 with a partner, and your goal was to take the structure and discipline of the large investment banking models and apply that to the lower middle market. Walk me through that moment.
Absolutely. Both my partner and I were working at larger firms, doing bigger deals, and noticed that there was a significant gap in the market of the representation that these companies in the lower and middle market were receiving. So you had business brokers that typically handled companies that were either retail-based or what they call Main Street businesses. And then there were some smaller banks, but that lower middle market wasn't getting the process that we were running at the larger banks. So we kind of devised a plan to take that process and apply it to these companies. And what that means is all of our outreach, all of our kind of selling is very proactive instead of reactive. So we don't post on websites. We don't post sales processes or our sales prices. We run a kind of a full sales process. We do everything, like you mentioned, the boutique, which we'll get to here in a minute on what that really means on all of our deals. So we really launched in the thesis of kind of taking that process and applying it to these companies. And it's been really successful so far.
Excellent. And Aaron, what were the early years like after launching the firm?
They're really interesting. We were in our late 20s. We call it before kids. Neither of us had kids at the time. So we felt like it was a good time, at least career-wise, to launch a company. Since then, I've had two. My partner's had three. So we're very family-oriented here at the firm. But really, the first year we took kind of a step back and really spent the time building out the back structure of the firm. So we built out all of our legal documents. We built out all of our marketing packages. We went on a pretty extensive roadshow to meet with private equity groups, family offices, all different types of people to kind of really understand the market and understand where that market was going, what was coming, and, way the deals worked. And from there, really started kind of getting our feet wet into the deals and kind of went full force after about the first year or so.
Okay. Thanks for that. And Aaron, one thing that stood out when we spoke earlier was your early focus on the veterinary industry. You mentioned helping veterinary clinics operators sell their practice to private equity consolidators and that you have completed dozens of transactions in that space. That's a very specialized niche. How did that focus develop?
Yeah, we're still extremely passionate about the veterinary industry, and we spend a great deal of time there and have kind of since our founding. And really what that came from was before starting Sterling Point, I worked on a deal where we sold a veterinary clinic to a private equity-backed consolidator. And at the time noticed that there was a significant amount of interest for kind of this smaller clinic and really started digging deeper into the industry and noticed that there was a kind of a wave of capital coming. There was only a couple buyers at the time, but there was groups that were forming to specifically go out and buy veterinary clinics. And we kind of said, hey, this is a really good industry that we should try to specialize in and really spent our great part of the first probably 3 or 4 years really fully focusing on that. And like you said, I've sold tons of veterinary clinics all across the country and know the industry very well and really have all loved the space and kind of helping these owners realize kind of their career ending and their next phase of their life and really appreciate those types of owners, which we'll get to also later on. About a lot of vets did not go into the industry and necessarily in order to make a ton of money or sell their clinics and might not even have realized. So we feel like we add a ton of value in understanding the full value of their clinics when they're ready to exit.
Okay. And Aaron, do you feel like that specialization helped accelerate your early growth?
A ton. They're very, as a lot of industries, they're very close knit. So a lot of veterinarians know other veterinarians, especially from their school days. So once we sold one here, in Virginia. She had some friends, called them, and from there it spiderwebbed all over the country. I think from here it went all the way over to Iowa, to California, and back and up into the Northeast. So we've been to some really incredible places and met some incredible owners and seen some great clinics. So absolutely, that specialization really helped us kind of not only start the company, but really get the growth that we wanted to see, and then has kind of fed the growth that we are seeing today.
Okay. And later you mentioned that growth started expanding beyond veterinary through referrals and relationships, and that connects directly with the theme of this podcast. You described your firm as a highly relationship driven, staying closely connected with past clients long after the closing transactions. You mentioned sending birthday gifts, graduation gifts, and maintaining regular contact. That level of relationship continuity is uncommon. How intentional was that strategy from the beginning?
Yeah, that was something when we kind of talk about that year we were building out the firm that we were really, really focused on. And one of the founding principles of Sterling Point was that we wanted to make sure that every transaction we dealt with was very personal in nature. So you weren't going to be a number. There's a lot of big firms out there where you're transaction 112 and you're going to get somebody and then you're going to get multiple people throughout the deal. We wanted to make sure we were very, very involved in that process, very involved with our clients. We're very big face to face, which is also a little unusual, especially after the 2020 era. So we still fly and meet all of our clients. We see all of their buildings, we see their businesses, we see their towns, we drive around the towns. So we really can kind of feel that passion when we're selling. And like you said, we're very close to our clients. They know about my family, I know about their families. We stay in contact. I would say a lot of calls we do, even during the deal, are not deal related. It's, hey, did you watch the Masters this weekend? Or, hey, how was spring break? And what did you guys do? And, love to hear that. And then even after the deal, stay in very close contact with all of our past clients to see kind of how that transition went, help where we can, and then eventually hope that leads to either something else or just that it's a good client relationship in the future.
And that's amazing, Aaron. And I believe that approach to having a authentic relationship with your clients builds trust. Would that be true?
Absolutely. Yeah, I think that really helps as anybody listening would understand, when you sell your business, it's a very personal transaction, right? It's obviously your business, but it's most of the time it's your baby. 95% of the time, it's probably the only time you're going to do it in your lifetime. So it's a very emotional part of your life. So we want to make sure that we're close enough that we can have those emotional conversations. So we've had lots of clients get, very stressed out during the deal, and having that kind of personal relationship where they can talk about other things, where we can kind of be that sounding board, kind of being that middle part between the buyer and the seller, really helps get those deals done. And we think that's one way we've closed so many deals and kept so many deals, alive after, the process has gone through and on to closing. It's having that relationship with the clients and making sure that they know we truly care, we truly are fighting for them, and we're on their side.
That's great. And today, Aaron, how much of your growth still comes from referrals?
Decent amount. I would say probably at least 70 or 75% is probably from referrals. I think one thing we have noticed, which I'm sure we'll dig into, is, obviously they're somewhat sporadic and unknown of how a referral will happen. But we obviously want to make sure that that's something that we're always kind of cultivating. So about 2 years ago, we did expand into some other ideas. So we have started doing things like these podcasts. I've spoken at a few conferences, which I've really enjoyed, just trying to get out there and speak with people about how, the market is or how the sales process works, but also while cultivating those referrals and those relationships with everyone, from past clients to also some kind of close-knit centers of influence that we use to talk about deals. And I think here is a good point to mention, most of our conversations never go anywhere, right? They're just educational in nature, and that's what we enjoy. So we are always happy to have that, hey, what's the market? Or hey, what's my company worth? Or what should I be doing differently? We have several of those calls a week for the last 7 or 8 years and love having those. I mean, this is my passion in life. This is what I enjoy doing. So I love talking about it. So I'm always, happy to have those conversations and hope that maybe 2 years from now, they'll think, oh, that's right, Aaron mentioned that. I should give him a call, and we're here for that.
Okay. And Aaron, you described Sterling Point as a boutique advisory firm where you personally stay involved from the initial introduction through closing. You're on the calls, you're involved in the marketing, you're part of the diligence process, and continue supporting the clients after the transaction. And that is very different from the traditional large bank model. What advantage does that create for your clients?
Yeah, I think there's a couple advantages, and I'm not necessarily saying that obviously the big bank model is the way it is because the companies are selling are much larger, so they don't really
Mm,
have as much of that kind of personal connection. A lot of times, you're dealing with investors or boards or executives and things like that. So there's just a different process. But for these lower middle market deals, when you're dealing with an owner that's selling, we wanted to make sure that that continuous flow is there from the start to the end. So instead of having a deal team that originates, a deal team that markets, and then a due diligence team, we want to make sure that person is the same through all of those. So I think that does two things. One, it gives them, like I mentioned, that emotional sounding board, and it gives them one point of contact. All my clients have my cell phone number. They text and call. I talk on the weekends, at night, early in the morning, depending on where they are in the country, all different times. But then really also giving me the ability to really foresee any issues that may come up really early on. So there's not
mm.
any surprises or very few surprises in any of our deals anymore because we've been involved kind of from day zero. We're doing a lot of deep diving before we even go to market and saying, okay, well, this is going to be something that's going to come up. We need to bring this up front and center so this doesn't come up 6 months from now, right before closing. But having that kind of relationship and having kind of that boutique model of being on all those calls, being there really helps you kind of guide that process, and not only guiding the seller, but it's also guiding the buyer as well, because then I can, really explain to the buyer all the ups and downs and the positives, the negatives, and being upfront with them and making sure they all understand. And so that point, once you sign an offer letter or an LOI or IOI, that process from there to close is much, much smoother.
Okay. And how do you balance service quality with scalability?
Yeah, this is something we've talked about a ton with my partner and I is, where do we go from here and how do we scale it? And I think right now we still really enjoy doing the deals. That's something I'm extremely passionate about, as is my partner Trey. We like kind of getting in the middle of the deal and selling. So at this point we've kind of kept our team small to a degree and really kind of focused on that in order to kind of keep working with clients that we want to work with. So we are somewhat particular that we do a lot of upfront digging and a lot of upfront questioning of our own to make sure a client's a good fit for us, as well as they're a good fit for, we're a good fit for them. But we want to make sure that we kind of can take on a client that we can close. We're not a shop that's going to take a ton of clients and collect a bunch of retainers and not close the deal. We have an incredibly high close rate because we kind of are picking those. I think there is avenues to explore that kind of can expand ours into other services. But at this point, we really like the model that we're doing and picking those deals that we know we can close. And we're still closing quite a few deals a year, for our size, and really enjoy that aspect of it.
Okay. And here's a new topic. Let's talk about valuation expectations. You spend a significant amount of time helping owners understand the difference between what they believe their business is worth and what the buyers are actually willing to pay. How frequently do you see that gap appear?
Pretty frequently, more nowadays, I would say, than 4 or 5 years ago. I think in the 2019 to early COVID years, it was kind of a little bit different because there was a ramping up of the private equity interest, and I think valuations really significantly increased. But it's a major component of what we do every day. And it's not necessarily always a negative. There are still industries where I think a lot of owners don't realize that their expectations are significantly under market, and that does still happen in quite a few industries, especially industries that are getting very sought after by private equity. But it's also understanding how the valuation works, and I think that's something we spend an enormous amount of our time here at Sterling Point doing, is really educating owners on how a company is valued. A lot of people get on ChatGPT, or they'll talk to a friend, or they'll read a magazine article and it'll say, hey, here's a high level how to value. But at the end of the day, there's a really specific way that most companies are valued, especially from a private equity, standpoint of using EBITDA and how they kind of apply a multiple to that you have to really understand. So I think a lot of owners sometimes are surprised. And again, it might be undervalued that they don't really understand how to calculate their EBITDA correctly. They're kind of seeing, hey, I made whatever $100,000 last year, and that's what my multiple is, and that number could be $300,000 or $400,000 when we're done kind of evaluating it from a strategic perspective. So it's really kind of understanding the way valuation is calculated, and then from there educating the client on how to reach a true valuation.
Okay. And Aaron, what's the most difficult conversation you regularly have with sellers?
I can think of two. One is, I would say, kind of going back to the valuation aspect, is the purchasing or the owning of assets is brought up all the time. And not necessarily usually on the veterinary side, but a lot of other industries, whether it's industrial or distribution or et cetera, which where an owner will come in and say, I have $10 million worth of equipment inside my building, so therefore I'm probably worth $10 million. I think that's a very difficult conversation to have where the private equity world has, basically decided that in order to produce the profit that you have to have had that $10 million worth of assets. That's not necessarily your value. So it's a tough conversation for a lot of owners, especially ones that have spent the last several years buying assets or purchasing fleets or whatever it may be, that those don't necessarily translate to any additional value to their company. So I think it's them understanding, again, the valuation techniques that are used and how that value works out. The second would be working capital. It's an extremely complex part of any deal. It's one that I think a lot of private equity kind of never can agree on what the true definition is, but that effectively, in the simplest of terms, it's money that you need to leave in the business when you sell. And that's money that basically is used for operations of the business going forwards. Most owners don't really understand it because it's not something you think about as an owner. I would never think about it because it's just kind of, your AR, your AP, your cash, your inventory kind of just sits there and it operates in some degree. You're never really sitting there calculating it for those reasons. So it's understanding that that's part of the deal separate than the valuation. So there's kind of those buckets that go into, and I kind of even can take here and really break those down. And really in any deal, there's kind of three major buckets. And the first is the true value of your company. That's what you're going to receive at close in some form or fashion, stock, equity, etc. The second would be your employment agreement, meaning as an owner, what you're going to be paid or your benefits that you're going to receive, whether it's for a short period, which we have, or some of our owners work for 10 plus years with the company they're selling to. And then the third would be any kind of lease on the current building that you own. If you're a third party landlord, obviously that would go to them. But if you're owning your building, it would be a lease to you as a landlord if you're not selling the building as part of the transaction. So really all three of those are kind of separately negotiated, but part of that full bucket. And then working capital is kind of that little bucket off to the side that comes in later. So you have to kind of really think about all four of those when you're valuing the company and when you're thinking about what you're going to walk away with at the end.
Okay. Aaron, you've completed transactions across many industries and states and worked through a wide range of deal structures. Looking back, what has surprised you most about this business?
Yeah, I think there's a couple, and I think the first one is the kind of rise of what we're calling the joint venture partnership. I think that's one that is becoming very common and becoming much broader in the sense of across multiple industries. This was something that it happened, 5-10 years ago, but it wasn't nearly as common as it is now. A large percentage of our deals are now using it. And what that is in the simplest is that it's you are retaining a portion of your company with the buyer as a partner. So you would sell, let's say 70% and you own 30% of your actual company. So it's not that you're owning equity in the larger business. You're not owning pieces of other businesses. You're owning your company with them in order to grow it in the hopes that you would exit at some point in the future your percentage for some higher value amount. So I think that rise of that has been really interesting. And I think it's a really interesting tactic for a lot of owners to use because we have tons of owners now. I mean, talk about looking back when we first started this, most of our owners were really at or near retirement age. They were probably 55, 60 plus was by far our average age. Now that number's dropped drastically. We work with tons of owners that are in their early 40s, late 30s that are just kind of saying, hey, I've reached a point where I'm not really sure how to grow this or what to do next or which avenues to go down or what to invest in. So I really need to bring someone in to help me kind of figure out that next stage. And a partnership might be a great model. The second would be just the broader private equity world. I think I might have mentioned this, Mark, when we had talked that there's been some articles lately that I'm sure people have seen that there's 14,000 McDonald's in the US and now 19,000 private equity groups, which is absolutely crazy. So that means there's so many buyers and there's so many different types of buyers out there that has really been something that's just been hugely eye-opening for us here at Sterling Point. We have a saying when we started the company, which is every business can be sold, and we truly mean it. Our first deal we ever closed here was a large lumber mill, basically cutting giant logs down to boards, where at the time the owner said, I'm gonna close up, I'm gonna take this to an industrial auction, everyone's gonna lose their job, and we're gonna sell it all, and that's it, I'm done. And we kind of said, you know what, I think we can figure this out, right? I think we can find a buyer. Somebody will look at this. We got several bids, sold to a very large buyer out of the South, and they kept the mill open, kept all the jobs, and put a bunch of money into the mill to kind of keep it moving forward. So we've had that passion really from the beginning of any company can be sold. It just depends on who the buyer is and what the structure is. And we want to be there to help them guide them through that. So those two, I think, have been the really big I guess, the industry that we really had no idea were coming when we first started this.
Aaron, that's a great success story about that mill and being able to keep it open and those people to keep their jobs. And that's excellent. So what lesson do you wish every business owner understood before entering a sale process?
Yeah. And that's one that I think we always joke that I probably need to write like a mini book at some point to give our lessons that we've come with over the years. I think one is kind of just understanding the sales process. I think really having a high level understanding of exactly what it means. I think a lot of owners have, rightfully so, been very good at negotiating. They've dealt with contracts, they've dealt with clients, they've grown their businesses. Maybe they've, bought and sold assets, bought and sold real estate. It's just a very different type of transaction, especially from real estate. It's just run differently. So I think understanding, one, the timeline, two, the parts of the process, how the process works, is something I wish everybody really understood. Two, I think, would be going back to that EBITDA discussion and profit discussion, which is truly understanding what their profit/EBITDA is and how that is applied to their value. I think really having a good understanding of that makes you much stronger in the market and makes you much more educated to talk to these buyers. Because I think a lot of people don't realize when you're, let's say you were to market yourself and you were to call a private equity group's an expert at buying you, right? That's what they're there for. They have a whole team of people that buy tons of companies. They know how to negotiate and they know how to get good deals, and that's what they're there for. So you need to really use an advisor like myself and others that really understand the way private equity plays that game in order to kind of get the value you need out of that business. And then third, and probably maybe even the most important, is truly understanding the legal implications of any process. When you sign those legal documents, when you look through those legal documents, when you sign on the dotted line, what that means not only for immediately on closing, but also for years to come. So I think we have lots of owners and people over the years that have called us after they sold their company and say, man, I really wish I would have thought about this, or really wish I would have negotiated this. So that, again, that's where an advisor can really help you. I've read hundreds, if not now thousands, of legal documents. I'm on all those calls. So I understand, the way private equity puts stuff in there and the way they negotiate that. So you really need to really break down that kind of legalese into really understandable topics. I mean, not only do you need to use a good M&A lawyer, but you really need to have someone that can help explain that to you in plain English. You understand what the implications are. I mean, there's everything from, obviously your benefits, your salary, your PTO, et cetera, all the way down to things that may come up later on. So you really want to make sure you really have a good knowledge of that before you kind of close the deal, because once it's signed, that's it.
Right. So Aaron, looking ahead to the next few years, what changes do you expect in the M&A market?
I think one is still kind of what I'll call the mass consolidation of certain industries. We've been tracking that, and everybody's seen it all the way back to the 80s, 70s, 80s, 90s. 90s, it was dental and certain healthcare. We've obviously ridden through the wave of the veterinary industry, and that continues to go through. But there's new industries every day that private equity will latch on. Right now, we're really deep in the commercial landscape space. That's getting an enormous amount of private equity interest. There was just a few buyers a few years ago. Now there's tons more kind of knocking at the door trying to break in. So I think our thesis is tracking those industries that private equity really is getting hot on, following what that looks like, and it changes on a whim. I mean, it can be anything, and really just changes depending on the environment and what a private equity group looks at. And usually, honestly, it's once a private equity group does have a little success, everyone else just kind of follows. So they keep following those. Following those trends is very big. I think two is just mentioning the number of private equity groups. What that translates to is the amount of capital. What sometimes you'll hear as dry powder that's out there, and that's the money that groups can use to purchase companies, is just sky high right now. There's so much money chasing deals that if you have a good company, you will get an enormous amount of interest from a ton of different buyers that have the capital and the ability to close. So it's really kind of understanding, hey, maybe I'm in a niche industry that I never really thought about, or, oh, hey, nobody wants me. That's just not true anymore. There's so much interest out there and so many different types of groups that are looking, that there's interest for everything. And then I think third is just the general M&A market. We saw a slight slump in 24, and there was a lot of groups that were on the sidelines looking for deals. And from the beginning of this year, this is the busiest Sterling Point has ever been. And we're kind of hearing the same from a lot of private equity groups, which is you want to capture that wave when it happens. We have a saying we use maybe 3-4 times a week, which is an X. And that X is your timing, which is kind of one axis. And the other axis is the timing of the market. And you want to make sure that when they intersect, that you're at the highest point. And a lot of owners will think, well, I'm kind of ready, but maybe it's a year or two now. But they need to understand when you're at this point with all this private equity interest, all this strategic interest, all this dry powder out there, that elevates their access. So you might have moved up your timeline significantly. And I think I'll add in there, a true common misconception for a lot of owners is I can sell, in 2 years and walk away in 60 days. That's much more difficult nowadays. A lot of groups really want you to stay on for at least a period of time. Maybe it's a year or two to kind of help with that transition and kind of help with the success of the company. So if you're thinking about this and the valuations are high, you really want to kind of think of your timeline, but then that timeline has to, align with the private equity or the buyer's timeline. So you want to make sure those are kind of in alignment when you're going to market. So I think it's really just understanding, where that goes, what that looks like. But the market is great. It's a really hot market across a ton of different verticals, and it's been a really fun start to 2026.
Okay. Aaron, this has been an excellent discussion. You've really provided some valuable insights, and I'm sure our audience will leverage those and use those. But before we close, if someone listening wanted to connect with you or learn more about Sterling Point Advisors, what is the best way for them to reach out to you?
I'm, again, always available. So you can call, text, email. We can link it in the podcast, but I'm always available. Yeah, shoot me a text, give me an email. Again, there's nothing we charge for any kind of conversations or valuations. We do all that as part of what we just offer at Sterling Points. We're always happy to have a conversation. So test me on the market, test on what questions you have. I love talking about it and always happy to do so. So I'm always available to have a chat.
Excellent. And Aaron, I will put your contact information in the description of this podcast. So that's excellent.
Awesome.
And thank you again for your time and perspective today. We appreciate you joining us on Growth Without Referrals.